and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in just a moment, we'll discuss the markets ahead, of course, of the Fed decision later today with Ursula Marchioni from BlackRock. But let's also start with the tech story that's really been dominating the agenda. Now, after ASML's big earnings beat, we'll explore what's next for AI chip making. But first, a Bloomberg scoop and the latest on DeepSeek. We understand that Microsoft and OpenAI are investigating whether the Chinese AI startup actually obtained unauthorized data output from OpenAI technology. Now, for more, we're joined by Mark Bergen, Bloomberg's EMEA tech editor. So, Mark and Ursula, thank you both. I mean, this, again, feels like a big deal, not quite the earthquake that we saw a couple of days ago. I mean, what does this mean? What does this probe actually look into?
Yeah, it's a rumbling for a potential earthquake, which would be if Microsoft and OpenAI came out and actually said, in fact, we found evidence that DeepSeek, kind of what the term here is distillation. It's effectively like kind of going and accessing the OpenAI API and basically scraping a lot more data than OpenAI allows, and effectively like building the model off the backs of OpenAI's model. And so that's been circulating the past few days, circulating in Silicon Valley and tech circles saying, listen, some people were impressed with DeepSeek. It's definitely an impressive model, but there's maybe some evidence or certainly some speculation that they were standing on the shoulders of someone else. But,
I mean, does it matter at the end of the day? I mean, if this is a new model that they can use cheaper chips and this floods the market, I mean, there's also news that Alibaba is talking about, doing something similar. Does it, does the lawsuit actually change anything?
I think it undercuts the thesis of, and the market's response was, here was this startup that was able to build something on par with OpenAI with much less on a shoestring budget without using the latest GPUs. There's some evidence that, in fact, they had a big head start by taking some of the data from OpenAI. That really kind of undercuts that thesis. Now, you mentioned Alibaba. As far as I know, there's no evidence that, or even suggestion that Alibaba's done the same thing. But they're obviously a much more well-capitalized company. In some ways, we would expect if a model came out of China, it's going to be Alibaba, Tencent, or ByteDance, so a little less surprising.
Really, it's one of the most incredible stories that we've been following. Talk to me about ASML. So they beat earnings, and I guess it also gives a bit of hope to the tech sector.
Yeah, there's certainly some reassurance. I think from what I saw this morning, that kind of rebounds and their shares are kind of erased the losses that they had for the past 2 days. Didn't see any evidence immediately. I mean, let's be clear, though, ASML sells this $300 million device that is critical to making these chips, but it's not like orders are going to stop on a dime for the company. So I don't think there's an expectation that we're going to see it today. They didn't, as far as I know, the CEO didn't address it in the comments, so they're certainly not, talking about this being a critical change in their strategy and their direction. But certainly some reassurance. We've seen that kind of some of the suppliers for NVIDIA also in Japan came out and made similar comments saying, so far we haven't seen any change on our orders or anything drastic that sort of the market reverberations from Monday would suggest.
Mark, thank you so much for joining us. Bloomberg's EMEA tech editor, Mark Bergen. Now let's dive deeper into the markets with Ursula Marchioni, head of EMEA Investment and Portfolio Solutions at BlackRock. Ursula, thank you for joining us. Frankly, there's a lot, right? There's the policies, there's the Trump tariffs, there's trying to understand what happens with AI, and then we're in the middle of earnings season. And the Fed. So if you look at all of these, what do you think will weigh more on investors' minds?
It is an eventful week, for sure, and thank you for having me, Francine. So maybe following on, looking at the equity markets to begin with, because that's how we began the week. We have a theme for our 2025 outlook, which is focus on the US with selectivity elsewhere. And I think that we very much hold on to that for now. The thesis about US exceptionalism is founded on 3 arrows: strong economic growth, although married with sticky inflation, strong earnings, very high bar, but thus far has been met, and we'll see how the week develops tonight and tomorrow. And then 3, technology and leadership there. So the rambling this week is really around that third component, and more specifically chip makers and power. So again, I would say until a potential threat spreads across those three pillars, we can continue to hold on. I think from a European perspective as well, we've seen a lot of clients towards the end of last year moving equity benchmarks from MSCI Europe to World, and so there's also structural demand for the US. So for me, it's really not necessarily around if, but how. So this week is really informative in terms of looking at the potential benefits of blending top 20 and S&P equal weight. We've seen 70% of the S&P going up, actually, on Monday, apart from the MAX 7, and then coming down yesterday. So the decoupling somehow of those two blocks is important, and so having granularity to play it, I think, is the way forward there.
Ursula, I mean, there's also a lot of talk, of course, about what the Fed does next. We've seen a lot of volatility just 3 weeks ago because of that, also infecting, for example, UK gilts. When you have these bouts of volatility, do you try and stay the course? Yes,
so it's interesting, and you referenced to the UK, and there is really a global phenomenon that got exacerbated there, in terms of sentiment and thin liquidity. I think taking a step back, if we look at today, tomorrow, we expect the Fed to keep rates steady, provide limited guidance forward-looking. On the ECB, we align with consensus 25 bips, and then probably back-to-back cuts into the mid of the year. However, whatever happens after that in Europe is slightly more up for debate. You mentioned tariffs. There's going to be a lot of attention to potential trade frictions. Zooming out, we're looking at a year-end where we have a clear central bank divergence, call it a 4% stateside, 175 here. So again, to your point, how do we put that into portfolios? Another key theme for us is quality with carry with quality, actually. And so I think that we prefer quality spread vis-à-vis duration because of that US view. At the same time, in Europe, there's opportunity for rates, and we also like that carry element in terms of euro high yield. So there's a lot to do in fixed income as well, but I agree with you. It goes back to the volatility and using nimble instruments to implement.
But when there's a bout of volatility, is it a good time to get in? Or is it better to wait it out? Because, there's so many competing forces, and frankly, it's unclear whether Donald Trump wants a lower dollar or he's okay with a high dollar, and that will change everything in terms of the policies he puts in place.
I agree. I think we need to continue to stick to the North Star. So I've articulated our core views. Again, every investor, depending on their portfolio, we have theirs, and stay the course there. At the same time, the opportunity set in terms of tools that can be used and the granularity, the greater granularity that we have in terms of instruments provides opportunities for tactically capturing alpha, which I think should be embraced. And so it's a bit of both worlds. Europe is another great example here, very much a contrarian view for now, but we've started to see some clients warming up. We saw nearly 3 billion in ETP inflows year to date, which is a big difference vis-à-vis before. So I think loads of elements for us to continue to monitor at tactical level while staying the course on a strategic asset allocation front.
And Ursula, in terms of Europe, is it certain industry groups that you think will perform the best? Luxury has gotten slamming, that it was going to be the big thing that actually maybe outperformed, and then yesterday got shot down. So again, it's very difficult to read if it's tied to the Chinese economy.
It is difficult to read, which is why selectivity, embracing active opportunities is still the way to go in our view. But what I hear from investors around Europe is really twofold. On one side, potential stabilization of politics at single country level, coupled with potential, resolution of geopolitical tensions looking east in the bloc. And then two, on the earnings front, you're right, we don't see the strength that we observe in the US. At the same time, the bar is lower, and so opportunities for potential upside surprises might come up. So again, still a contrarian view, but in that sense, one worth watching.
Is there anything at the moment that actually you really want to stay actively away from?
Actively away from? That's an interesting question. The point that you mentioned in terms of the level of uncertainty, tariffs, but also regulation is clearly elevated. And so there will be areas where, I think on a relative basis, when you see clear opportunities, they probably aren't worth taking the risk.
Your take overall on China, again, it's unreadable, also given the policies from Donald Trump that, tariffs, but maybe will be lighter, maybe not. Does that get ramped up with some of this DeepSeek AI, or do you see tensions go down and therefore leading to opportunities in markets?
I don't see a lot of interest from clients in actually testing that thesis. So I agree with you that there's a lot of attention. Obviously, Lunar New Year, what is going to happen when we come back? Is there going to be some policy support that gets announced? Could that be a catalyst? There's a lot of debate around all those themes. But in terms of people moving money, if I look at data, it seems to me that clients are concentrating on the calls where they have conviction and then buying time to observe how to further diversify into potential other areas.
Ursula, thank you so much for joining us on probably one of the busiest weeks, maybe. Let's see let's see what next week actually brings us. Ursula Marchioni, head of EMEA Investment and Portfolio Solutions at BlackRock. Now, coming up, we'll also be live on the ground at the EPAM Private Equity Conference in Cannes to discuss the outlook for the industry amid 2025's headwinds. That conversation next, and this is Bloomberg. After a slow start in 2024, alternative asset managers are finally starting to see some success with Europe's wealthy by offering something investors crave, and that's better liquidity. Well, the prize is a potential $10 trillion opportunity to be tapped from Europe's high net worth individuals. Now, at this week's EPAM conference, participants are debating how best to leverage a region that's home to almost a third of the world's millionaires. Let's bring in Bloomberg's Kriti Gupta, who's at the conference in Cannes. Hi, Kriti.
Hi, Fran. Thank you so much. Yeah, we're right here in Cannes. I've got the best assignment. We're in the best spot. And we're talking about everyone's favorite subject, which is, of course, wealth, how you get it, how you distribute it. I've got the perfect guest to talk about that. I'm joined now by Apollo's Veronique Fournier, the head of Apollo's global wealth business, valued about $30 billion in terms of assets under management. This is a really important time to have her. Thank you so much for joining the program here. It's fascinating because there's so many things to talk about, but I just want to go big picture here. You have a really interesting title, Head of Wealth. What does that mean right now? What are people talking about in the wealth space?
Yeah, great. Well, thanks for having me. I think as an organization, we've been in private markets for very many years, but typically have had, most of our clients coming from the institutional space. And it really has been a great development in the industry to have seen also wealth investors now looking to have access to the great solutions that you can find in private markets. So really, we're trying to help private investors get access to opportunities that they haven't been able to get access to before. And that's really trying to give them, better diversification in their portfolios and moving away from those, traditional days where alternatives used to be a very small niche pocket of your portfolio to something where, we see potentially wealth investors having allocations up to 50% in private markets.
That was the case that was made, with the public markets back in the day with the stock market, right? That you get a share of a company so that you are part of that wealth creation story. Is that kind of extent of democratization, I'm going to say that word right, kind of what you're starting to see in the private markets? Are we there yet?
Well, I think what we are starting to see is a recognition that, there used to be a world where, public companies, there were 8,000 public companies in the US, is now only half of that, 4,000, where the great majority of large companies are actually sitting in the private world. And to be able to access those types of opportunities or investments, the market is recognizing is really important. And so we are seeing many wealth distributors, so whether that's private banks or wealth managers, platforms, etc., all coming to the market and asking to have better access to these types of opportunities as we talked about. And certainly some have talked about that being the democratizations of alternatives. And certainly that's a big theme and one that we're talking about here today in Cannes.
Yeah, it's a fascinating one. We're right here in Cannes, a beautiful landscape. Things feel quite literally sunny, but metaphorically sunny as well. Yet there is kind of this almost overhang when it comes to French politics and the kind of marriage of that and the effect of that when it comes to the financial markets and specifically in the private markets. How do you view this kind of democratization agenda or goal in the context of a fairly rough regulatory environment, at least when it comes to broader Europe?
Well, I think the regulator has, like many investors, recognized that there is great benefit for investors to have access to these opportunities in private markets. When you look at their traditional portfolios, a 60-40 portfolio, investors have typically had exposure to public fixed income, public equities, and haven't really been able to access these private opportunities. The regulator, I think, is recognizing that if investors are going to be investing for a long term, why should they be in daily liquid mutual funds? Why should they be obliged to have 100% liquidity? And so I think there is, from regulators, and in particular here in France, we've seen a regulator that has been very supportive of that trend to enable investors to access these opportunities, certainly when they're investing for a longer term.
Well, certainly interesting time to talk about deregulation in France, giving a little bit of catch-up as well to the States. Let's talk about the other theme that I think is dominating, certainly the public markets, perhaps a little bit spillover to the private markets, is the market turmoil we saw on Monday with this kind of AI story, this collapse in the cost of innovation, maybe more accessible, not just from the mega players of the US, but perhaps from the rest of the world as well. How does that show up in your space?
Yeah, I mean, we've been talking for a while about the concentration in public equity markets, potentially an environment of higher for longer, and what that means for investors who are solely allocated to public markets. And really the big theme that we see is the need for diversification. And so we talked about that already in terms of in a fixed income portfolio where traditionally investors would have had only public exposure, but the same thing on equity, is replacing some of those fixed income allocations or public equity allocations and integrating some private, whether that be high yield, whether that be investment grade. We have a diversified private market strategy that we have run for our own balance sheet for many years, that we opened up to investors as an equity replacement, and we're seeing a lot of interest in those types of strategies. Yeah.
So how does the volatility that you see in the public markets show up in some of those private markets, or is it maybe an incentive then to get into the private markets to escape the turmoil of say, a 17% drop in NVIDIA?
Yeah, exactly. So I think that's what we have seen is the need to step away from sort of those more volatile markets. And certainly as we saw that, in 2022 when there was no hiding place and people experienced high correlations in their portfolios, the big driver has been trying to step away from potentially liquid markets to reduce some of that volatility, dampen some of that volatility. And we think the promise of private markets should be, excess return per unit of risk. And then certainly I think that's what's driving a lot of the demand right now.
Yeah, the stars perhaps aligning. Veronique, always a pleasure to see you. Thank you so much for joining me right here in Cannes. Veronique Fournier there, the head of wealth over at Apollo, talking there about, well, maybe the turmoil of Monday is just yet another example of one, Fran, the need to deregulate, and two, the need to diversify via markets that maybe weren't as liquid and weren't as accessible just a couple of years ago. That's the case being made at Apollo right here in sunny Cannes.
Currie, thanks so much. Great interview, Currie Gupta in Cannes. Much more to come, and this is Bloomberg.
The issue is that we need to understand that bigger banks can provide better services at lower cost. And we do understand that issue of scale. If people go to big supermarkets, why? Because they have wider offers at lower prices. It's the same with banking. If we have bigger banks operating cross-border, it will be to the benefit of all clients.
Well, that was Maria-Louise Albuquerque, the EU's Financial Services Commissioner, speaking exclusively to Bloomberg's Ollie Crook. Now, Bloomberg has also learned that Apple has been secretly working with SpaceX and T-Mobile US to add support for the Starlink network in its latest iPhone software. In an under-the-radar move, the smartphone's latest software update, released this week, now supports the technology. Now, the initial version of Starlink is exclusively for texting, but SpaceX and T-Mobile have previously said they plan to expand into data connections and voice calls in the future. Coming up, Jeff Currie from Carlyle on his outlook for the energy and commodities market. That conversation is up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Bloomberg learns that Microsoft and OpenAI are investigating whether a group linked to a Chinese startup, DeepSeek, obtained OpenAI data without permission. ASML surges as fourth quarter orders smash estimates, with the AI boom driving demand for its chip-making machines. Plus, focus turns to the Fed, which is set to leave rates steady as it braces for the impact of Donald Trump's policy. Now, a federal judge has temporarily blocked the Trump administration from enforcing a directive to halt the payment of federal grants and loans. The president's surprise move, which is meant to ensure that government agencies are aligned with the agenda of Make America Great Again, sparked panic in Washington, with many local officials across the country. Well, the White House defended the new measures.
Again, I would say this is not a ban. This is a temporary pause and a freeze to ensure that all of the money going out from Washington, D.C. is aligned with the president's agenda. And as the Office of Management and Budget has updates on what will be kickstarted once again, I will provide those to you.
I mean, the new press secretary, I have to say, was really quite tested on that yesterday. It's the first time we heard from her. Now, for more, let's bring in our EMEA News Director, Roz Matheson. Roz, when you look at, I mean, it feels like after a lot of policy talk, of tariff talks, the Trump administration is looking more inwards in terms of what they can do for spending freeze and more domestically. What did you learn in the last 24 hours?
Well, it all reflects this very busy effort in the early days of the Trump administration to do a lot. There's been a blizzard of executive orders, be they domestic related or internationally related, about the border, obviously, issues around migration now we see on spending, but also a lot of activity overseas as well, threats of tariffs, a lot of fanning out by Trump administration officials overseas already. But interestingly, what this shows us in all of this blizzard and this effort to do stuff quickly, there can be unintended consequences. And this announcement of this freeze, as you say, did cause quite a bit of panic yesterday because they had to clarify very quickly this did not affect things like Medicaid, social spending, rental assistance, urgent payments to individual Americans. But even though they clarified that, some states were reporting difficulties accessing those portals. Some of those payments did seem to gum up immediately, and we could see more of that today. So in doing these very broad directives, and that's what a lot of these executive orders and other things have been from the White House, when you do something very big and broad like that, you can have these knock-on effects, and that's probably an early lesson for the Trump administration. It's also a question of just the level of executive power here, because a lot of the fiscal stuff, I mean, stuff around budgets really generally resides with Congress. And are you going to see Republican lawmakers as well as Democrats, I mean, not Democrats, obviously, but Republican lawmakers be comfortable about that, about ceding, in a way, some of the legislative control of the purse strings to the executive for Donald Trump to be able to make these kinds of blanket announcements? That will be interesting to see just how many Republicans are quite comfortable with that or not.
Yeah, and we've heard many also, press reports on the fact that this hurts research, including some of the tech and AI projects that could be in limbo. We also heard from the president that he's offering buyouts to workers who don't want to return to the office. This feels quite significant, Roz.
Well, that's right. About 10% of the government workforce, these agencies, are permanently work from home. And that can be for a variety of reasons. That can be because of the physical inability to get to an office, and many others work partially from home. And what he's saying is, if you don't want to be in the entire time, we'll pay you out if you want to go now. This obviously doesn't affect the military, it doesn't affect postal workers and others, but it's really in line again with this agenda of bringing workers back into the office, and very much something that Elon Musk was big on at his own companies. He famously issued his own edicts to his employees to get into the office or be fired. And we saw that that didn't necessarily go according to plan, because we saw some people were fired or left, and then they had to bring them back because they lost so much core expertise in those departures. So the question is, how successful would this be? Are there ramifications from it? We know that some of these areas are quite unionized. You can imagine this will get tied up very, very quickly in legal measures to try and stop it. But it does, again, reflect that effort, that broad effort to reframe the entire government, agency by agency. We saw very quickly Donald Trump moving to get rid of some inspector generals. He's withdrawing security support for some former Democrat officials in the Biden administration and so on. So he's really trying to reshape the whole architecture of government to his priorities, and that includes these federal agencies.
Roz, thank you so much. Roz Matheson there, our EMEA news director, of course, talking about Trump and what we found out this week. Now, President Trump has also threatened widespread tariffs on sectors including steel, copper, and aluminium that could reshape U.S. supply chains. Now, commodity traders are also keeping a very close eye on what his administration could mean for energy prices, saying he wants drill, baby, drill. Let's bring in Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. Jeff, as always, thank you so much for joining us. I have a lot of questions on Russia, on drilling in the U.S., but maybe let's start with what we heard last week, which was the president really reaching out and calling for OPEC to lower oil prices. Will they oblige?
Well, they're planning on increasing output in April of this year. And I think we have to put that increase in the context of sanctions and potential tariffs in Canada. And that's what the market's focused on in the very near term. Sanctions have already taken out anywhere from 1 million to 1.5 million barrels per day of Iranian and Russian crude. It's probably there's some redirection going on, but you're losing oil. You can see it in the time spreads on the oil market. And then the big question is Canadian tariffs. I don't think they could do it because it would be so explosive to, as you point out, supply chains in the U.S. and gasoline in particular. But between all of those events, more than enough room for OPEC to bring on that supply come April.
Yeah, so Jeff, so again, there were many questions on whether, the new sanctions on Russia really affected supplies. You say yes, undoubtedly.
Yeah, I mean, let's say, like the banks are saying 1 million barrels per day on Russia. The trade houses are saying 250.
Fine.
I'm giving you 500. By the bottom line, these ships are not going into those ports in India and China. Where they're going and where they're sitting, I don't want to get in that debate. Yep. The bottom line is you're not. But more importantly, by the time you get to 2Q, you have deficits in this market. And you get in 2Q, you have counter seasonal deficits. There's room for those barrels.
Does Donald Trump have a figure of what he wants oil to be?
If you go back to the last time he showed his hand on that was 2018 in a tweet of $75 a barrel. Clearly he may think it's,
He read the Currie report.
Yeah. But I think the key issue is, can he do a lot about it? Just like, it got out of control in 18 and went up to nearly $90 a barrel. And when we think about the current environment, he says he wants drill, baby, drill. Regulation is not a constraint on U.S. production. Capital budgets are there. And, the CEOs in U.S. oil companies said, hey, we're not going to change our policy right now. And I think the key issue is you look at U.S. production, slowing down. The growth is just not there.
But why? This is because of demand or just the price? I mean,
price and it's becoming the geology on the oil versus gas. You're getting more gas, more liquids than you are oil anymore. So the ability to grow oil. I like to point out, you're at 13 million barrels per day at the eve of COVID. You're at 13.2. Yeah, you went down to like 10 and 5 and back up, but you're not much higher than where you were in 2019, which shows you it's difficult to grow.
I find it incredible, and you reminded me, we have this, I see you more than once a year, but this is like our annual January catch-up, and it's incredible, like the price of oil is basically range-bound, right? It goes up and down, but broadly, it hasn't changed that much. Is this year going to be any different?
It's over 30 months now it's been that way. That's really, and actually there's only one other period it's been this long. It was late 2012 to mid-2014. We were at, I remember one piece I wrote, we just finished the year at $110.23 and started at $110.24. It's kind of the same. We're at 80, and change basically right now. What was the setup then versus the setup now? Exact same. The difference is China was America, America was China. 2012, 2013, you had a very weak Europe, an anemic U.S., and a robust China. We have a very weak Europe, an anemic China, and a very robust U.S. You can't get out of that trap. We went out of the trap to the downside because of a supply event. By the way, the one commodity that did move over that time period, gold went down. What happened over that time, last 2 years, gold has gone up. It's up $1,000 an ounce.
That's diversification,
Diversification.
Isn't it?
And I think the other thing, too, about this it'll be a supply event that gets us out of it. The supply event, I'd argue, is teeing up the other direction for less supply, not more supply.
Okay, so what happens in April when basically OPEC, restarts production? Does the price of oil move, or are there going to be different factions?
I would tend to think the oil's going to move sooner rather than later on that. The bottom line, these markets are getting tight. This time spreads on oil are telling you are very tight right now. Inventories right now are record low everywhere in the world. I've been doing this a long time. I've not seen inventories this low. A lot of it's destocking because you don't want to hold the inventory with high cost of capital. But there's also the fact that the supply is not readily available. The backwardation on Brent right now is an indication we are short oil. And when we go into late 1Q, get into late Feb, March, demand starts to pick back up again, and the seasonality could start to put a lot of pressure on the system. So I would tend to think we move sooner rather than later.
But, Jeff, have financial investors permanently lost interest in oil?
Well, I go back. The answer to that, right now, it's going to take a huge hurdle to get them back. Right. And I think part of it is it's a very volatile market. Even though you're pointed, we stayed flat over that time period. It was like an EKG over that time period. Yeah. 92, high 60s.
People are hiding under their desks.
Yeah, exactly. Yeah. And I don't even want to comment on the price right now. I'd rather do other things. But the reality is that discourages the investment, and then that discourages investment in the ground. It just compounds the problem and makes it worse as we look out further. But I think that's a really key point, is the investors are absent. And so any move has to be, you have to drive over the pothole for it to move. And are we going to drive over the pothole before OPEC raises production in April? Also by the time they raise production and the market starts to rebalance, it's going to take time. It's like turning a super tanker. You just don't immediately go there.
Okay, Jeff, stay around because we talk energy, AI, and data centers. This is like the hot topic du jour, so I want to get your thoughts on, of course, how much energy is needed and where that energy comes from. That's next, and this is Bloomberg. Welcome back, everyone. Now, still with us, Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. Jeff, thank you so much for sticking around. There's been so much excitement about DeepSeek and what it means, of course, for tech AI. How does this play out in the energy markets?
I think the key point here, we haven't seen the AI demand for energy yet. All we have seen is the data center demand driven by crypto and by cloud computing. So that's yet to come. And I was joking. In fact, 2 years ago, we'd be on here talking about, complaining about the crypto demand, creating a carbon footprint for no productive reasons. Bottom line, when people talk about data center demand, they're talking about crypto miners right now, particularly given current prices. So when we think about the impact AI is going to have, particularly on data center demand, that's something that's still yet to come.
But, Jack, can you give us a size and scope of how much more energy we need? Because the number of data centers that we're talking about and energy consumption is huge, and I just don't know how we'll deal with it. Okay, let's put power demand in perspective relative to the rest of the energy.
Power is about 20% of global energy, so it's not that big to begin with. Yeah. And then we take the growth in AI in the U.S. We're talking about 5% growth. Overall, power demand in the U.S. is running around 1.7. And so you hear these numbers, it's going to be the size of Japan. It's already the size of Italy. This digitalization, not data centers, I just call it digitalization. This has been going on for 20 years. It's a straight line going up, and it's going to be a straight line continuing to going up, and it's going to all you need is 2 to 3% growth in power demand in Europe and the U.S., and you got a problem. Because we have not been investing in the grid. Yeah. So we've seen a lot of investment in things like renewables, where you've displaced old power generation sources, but the overall grid and the ability to grow, it's not there. So even 2 to 3% type of growth in power demand is enough to start to create serious problems.
But so we have a problem.
Yes, we definitely have a problem.
Is there a way where you don't foresee us having a problem? If it's nuclear, or is there some kind of adoption?
When I think about the three key things you want to watch in commodity markets in 2025, fragility of supply chains is right up the top, followed by low inventories, and then followed by the dollar. So those are the three things. But the fragility of the supply chains, and I want to go over the Dunkelflaute in Germany this last winter, which is it means no wind, no sun, and really cold out. power prices went to 1,000 euros a megawatt hour because you couldn't deliver. And the thing we've learned about with renewables, it's turned the supply curve upside down. You can deliver them when you can produce them. You can't deliver them when you need them. And the market couldn't deliver the power. And also, we don't have a grid that's capable of meeting that excess demand. So supply chain fragility, not just in oil, or in power and gas. You see it in oil and refining and the rest of the energy supply chain. And I don't think that's changing.
But Jeff, and you've talked on the show before about, of course, the fact that copper is also needed to build some of the renewables. Now we have a rollback from the U.S. on renewables. So is this the perfect storm? And again, how should heads of state think about this?
Changing those regulatory and the mandates around this is not going to have an impact globally. Energy transition has been with us for 50 years. The late President Carter was the first one to use the term. In the 70s, Nixon implemented the energy transition in 1973 with his Project Independence. And so here's the irony of it. We saw energy transition was driven by the fear of running out of oil up until around 2015 with the big shale boom. Then around 2015 with the Paris Agreement, it turned into the fear of too much oil. And so we went from peak supply, or peak oil meaning peak supply, to peak oil meaning peak demand. Now let's compare the energy transition pace under the energy security or national security. It was 0.5% per year. It beat the net zero 2050 goals. So if we move energy transition to being driven by energy security and national concerns like it was in the 70s, with nuclear, it's probably going to go faster under that case than it did under the net zero 2050. So again, I think the key point here, this is not new. It's been with us, and it's just going to change the motivation. I guess the energy transition is in its own transition, but it's not going away.
I mean, in Europe, it feels so slow. Mm-hmm. Is Europe at a natural disadvantage compared to the U.S.?
Actually, Europe has just been charging ahead. Going back to the 70s, the French led the way in nuclear power back in the 70s under the Master Plan. That's not changing as in this current environment, because what is the focus? Man, Europe's going to take a while, but in places like the U.S. and the installation of nuclear power in places like China is just off the charts. So, I would say the motivation is going to change. Right. But the direction of travel, it's the same. And we've been on that highway for 50 years, and I don't see it changing.
Jeff, you wrote this great newsletter. Actually, what does this all mean for investors? How is it actionable?
We want to be long real assets. Whether they're, in the illiquid private markets, things like natural resources, infrastructure, real estate, but, liquid alts like, managed futures. These are all assets that have been out of favor for 20 years. And I think you can capture it in what's happening with the equity bond correlation. It's flipped on its head. By the way, when those commodities started behaving weirdly in late 22, is when that correlation flipped. The investors left. Why did the investors leave? Cost of capital went up, and they couldn't employ the leverage anymore. They're out of there. And you think about, remember the old world of risk on, risk off? That was because at 0% interest rates, you didn't care if it's bonds or equities. You just had liquidity. The question is, how much leverage were you going to apply? And you went into everything at the same time. Now with higher interest rates, you have choices. And what I'm arguing, the choice is going to favor these real assets when we start to feel the pressures of, the underinvestment.
Jeff, as always, thank you so much for joining us. That was Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. Now, coming up, we continue on the markets. Luxury stocks falling after LVMH disappoints, casting doubts on the prospects of a quick recovery in the sector. So we'll have a full lowdown on that next. And this is Bloomberg. Now to one of our biggest fallers in Europe this morning. LVMH shares slumping after fashion and leather goods sales. The luxury giant fell in the fourth quarter, casting doubt on the prospects for a quick recovery for the sector. Now, for more on this, we're joined by Bloomberg Opinion's Andrea Felsted. Andrea, thanks so much for joining us. I mean, I know you look at this day in, day out, trying to see what's doing well and not. LVMH was a bit of a disappointment.
It was fine, but it just didn't outperform in the way that the others did. Richemont really, beat expectations. Even Burberry, it was still negative, but it was nowhere near as negative as expected. And yes, LVMH did slightly better than analyst expectations, but after the bar was raised, that just wasn't good enough.
So is that because of who's buying luxury at the moment? Again, we're kind of missing the Chinese market. We're seeing millennials coming back up, but slowly.
It's really the US. All the action has been in the US since the election. We've had stock markets melting up until recently. Bitcoin, there tends to be a correlation with that and US sales. Plus, there seems to have been a sort of a bit of a recovery since the election. Even those that didn't like the result have sort of moved on and been slightly relieved that there wasn't an uncertain outcome, and add that to markets, and that's definitely, we're seeing the US recovering.
And there's all this talk about possibly looking at a breakup for the group. Is that, happy talk? Is that possible?
It is possible, but I'm not sure whether Bernard Arnault would really take an axe to the group he spent 40 years building. But then, he is a businessman, as we've seen, and the valuation seems to be being penalised by it having things like wines and spirits, the duty-free business. So, there is a case that if you concentrate it on pure luxury, so LVMH's PE ratio is about 25 times. Yep. Hermes is on 55 times. If you can get anywhere near that, you're not going to get to it, but if you can get anywhere near that, then that could potentially unlock value.
Andrea, to tariff or not to tariff? Bernard Arnault was at the inauguration, I guess, to keep the tariffs at bay.
Exactly. And it was really interesting yesterday because he was, really enthusiastic about the US. He said it was going to boom, really scathing about France. He praised the Trump tax cuts. He praised subsidies for manufacturing in the US, whereas in France, companies are taxed. And I think that was a real hint that if we are going to see tariffs, even if we're not going to see tariffs, they could, increase manufacturing in the US. They already manufacture some leather goods in Texas and California. We could see more of that.
Andrea, so interesting. Thanks so much, Andrea Felstedt from Bloomberg Opinion. Up next, Bloomberg Brief. Danny Berger and Manus Cran in New York. And this is Bloomberg.